hot war is escalating to a tremendous degree in the Middle East. Israel has launched airstrikes against Iranian nuclear sites, and retaliation is underway from Iran. This marks a dramatic escalation in the Middle Eastern conflict, and global markets are moving exactly how you'd expect when geopolitical risk goes parabolic. Risk assets are being sold off hard. You could take a look at the chart that I've already put up on screen just so people know what this video is all about. On the right side, right there. So you can see in the top right quadrant, I'll actually highlight this so you can see it. Bitcoin is down actually to a lesser degree than other risk assets. It's only down on the day 0.69 to 0.7%, whereas the S&P 500 is down 1%, Nasdaq is down 1.2%, and the Russell is down 1.6%. So this somewhat mirrors what happened on Liberation Day earlier this year. We had more geopolitical risk when Trump announced sweeping tariffs across basically every nation on Earth, and you saw Bitcoin and gold actually appreciate while everything else sold off. And so while I wouldn't call what's happening now Bitcoin detaching from global risk, I would say, and it's very clear in the market pricing, that it is dislocating somewhat. The cross-asset correlation between Bitcoin and the rest of the risk-on bucket is shifting. Typically, Bitcoin, of course, being a smaller asset traded with the risk-on bucket, it has a higher beta than traditional risk assets like the broader stock market, the S&P 500, just like the Russell, right? The Russell is down 1.7% because it has higher sensitivity than the S&P 500, which is only down 1%. But Bitcoin has a much smaller beta than it typically does. Typically, it has a higher beta to the S&P than the Russell, but today that's not the case. And so while I wouldn't say Bitcoin is trading risk off, it's certainly shifting in that direction over a very long time horizon. But more broadly, the classic flight to safety trade is lighting up like a Christmas tree. You could see over here on the left side, crude oil is up 8.2%, natural gas is up 3%, and of course, gold is up 1.5%. And something that doesn't generally happen, U.S. Treasuries aren't catching a major bid. Actually, rates are up all across the curve today. The 2-year is up 5 basis points, the 10-year is up 6 basis points, and the 30-year is up 7 basis points. So U.S. Treasuries are actually selling off, which generally isn't what happens. Generally, yields plunge as investors rush into sovereign debt for safety. That's the standard reaction. When the world gets scary, capital hides in commodities, which is what they're doing, and fiat-denominated government bonds, which they're not doing this time. But let's talk about what this actually means and what comes next. So oil prices ripping higher destroys any progress the Fed has made on inflation. Energy is the ultimate input cost. And so when oil spikes, prices rise across the board, from logistics to manufacturing, agriculture, you name it. And we just saw the largest spike over one day in crude in months. So this puts the Federal Reserve in a box. They can't cut rates into surging energy-driven inflation without risking credibility, despite the lower-than-expected CPI report that came out on Wednesday. But they also can't hike rates in a panic because that would collapse credit markets and break the economy. And frankly, the market's already doing that for them, right? You see all across the board, treasuries are being sold off and yields are moving higher. So rate cuts, for now, are off the table, and monetary policy is frankly trapped. And here is where the panic playbook fails, okay? Fleeing to commodities rather than fleeing to Bitcoin. In crises, investors run to U.S. Treasuries. Generally speaking, it's not happening just yet, but this is reflexive because bonds are liquid, deep, and historically safe. But that belief rests on a crumbling foundation because what comes after war and crisis, and frankly during it? Massive deficit spending, ballooning debt, and in some cases, stimulus either to the people or to the government, and ultimately, to fund all of this, money printing. So we've seen this every cycle. Panic leads to stimulus, stimulus leads to debt leads to debasement, and fiat gets devalued. That's not safety. That's just delayed destruction. That's safety in numbers, and that's not what you want. So what's the smart move? Don't flee to fiat. Flee from it. Bitcoin doesn't have a central bank. It doesn't inflate to fund war. It doesn't issue debt to back its credibility. And it's the only monetary asset that cannot be debased, censored, or printed into irrelevance. Today, the panic trade is into fiat. Tomorrow, the panic trade and the forever trade will be into Bitcoin. So right now, the smartest investors aren't following the herd into bonds. They're front-running the next wave of debasement by stacking sats. And you could see this only at the margin with Bitcoin's vastly smaller beta to the broader market during this particular geopolitical crisis. But in the future, Bitcoin will be the apex risk-off trade. For the time being, this allows you to arbitrage that. There's this massive arbitrage between how the market trades Bitcoin as a risk-on tech stock, similar to Uber or the Nasdaq, but its monetary properties allow it to be the apex risk-off asset that you want to own all the time, not just in bad periods, not only in good periods. For now, the market doesn't see that, at least fully, but that allows you to stack sats while there's panic. That's all for today's video. Thank you so much for watching. If you enjoyed, make sure to check out Horizon. It lets you stack sats using your home equity. You can check that out at joinhorizon.com or by scanning the QR code right there. And of course, follow for more so you don't miss when I post these videos, particularly as we head into the summer and markets are only going to heat up and get more exciting from here. That's all for today's video. Thank you so much for watching. I'll talk to you soon.